Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Friday, March 27, 2015. Inside the numbers, of course, we're going to talk about Intel. Everybody knows why we're going to talk about Intel. We'll do the S&P 500 via the SPDR and the E-mini contract. We'll talk about crude oil. We'll have a discussion about gold. We'll talk about interest rates in the bond market, and then we'll give it a wrap into the weekend. And I'm writing myself a note. I'm going to try and remember to cover GDX when we go over gold, and then we'll give it a wrap. So let's go over to Intel, okay? And here is a daily chart of Intel, right? And you see we had this big spike up today. Now let's go review something real quick because it's worth mentioning what goes on here. This isn't the area in here is not the area I want to focus on for a second. I want to go over here to yesterday. And in here, what happened was the market made a reversal. Went back and tested the low, and then we made a reversal. And once we closed above this pivot high here on an intraday basis over here, we were going to be off to the races, okay? More times than not. That's an indicator. It's a technical indicator that I use in order to find some bottoming signals. And yesterday we had a bottoming signal in Intel, okay? And if I look at the 60-minute chart, all right, it's a little more prevalent on the 60-minute chart, okay? You can see we made a bottom. We came down on volume, all right? And then we went back up, and once we got over a certain level, the market was, that level, which is right in here, became support. It was former resistance, became support, and then here we have a market taking off today. Now, this is a little bit lucky. We got a news item. Intel may be buying out Altera, so the market likes it. It sends Intel up. But the point is that the market or the stock was setting up in a bullish format. So whether it went up all in one day or whether it went up over the course of a week or two, either way, it was going to be the same result. Okay, we were getting higher prices in Intel, which is the reason why the trade alert went out yesterday, because we had the signal on the buy side, and either way we look at it, we were always going to get higher prices in Intel. But I just thought it would be fun to go over it. It's nice to have a pop like that in one day. It's up almost 7% in a one-day hold. I've still got it. I'm looking for higher prices, and that's going to tie into the market. So why don't we go over there now? Let's go over to the SPDR contract, the S&P E-mini, the SPY contract, and let's go over to the daily chart for a second. Okay, we'll go to the daily and then we'll work backwards. Yesterday we came into the 204. All right, we had this line in there the day or two beforehand. We came into the 204 and we bounced off of it, and today we held. Okay, now ideally, you would have liked to seen a close above yesterday's high, which would have been extremely bullish. Okay, but we didn't get that, but that's okay. One day at a time. What we will get, or what we should get, is more upside next week. Why? Because today should be a cycle bottom, a daily cycle bottom, which is a shorter term bottom, but it's a daily cycle bottom nonetheless in the stock market. And what that should mean is it should mean higher prices next week. Now, I still think that we're in a longer term uptrend, which should take us to higher prices. But first we have to take one step at a time, and we have to get through higher prices next week before we can talk about higher highs. Okay? So next week, we're looking for higher prices. We're looking for the sentiment to shift a little bit to the bullish side. My bias is going to shift to the bullish side leading into Monday and beyond. Okay, so we're looking for higher prices in the stock market. That's the other reason why I didn't sell out of Intel today, which was because if I'm looking for higher prices in the market, I'm looking for the market to inflate. I'm looking for all stocks to inflate. We have other trade alerts that went out yesterday. We have another chip stock, and we have another index that went out yesterday. So we've got stuff working. Everything's in good shape. And I'm looking for the market to make a move right here, right now. So we'll see what happens one day at a time, and we'll just take it from there. I think we can basically leave the stocks alone for now. Of course, if we went back down, the waterline, the line in the sand right now is 204. Any close below 204, something else is developing. Then you have your 200 period moving average, and beyond that, we're going to look around the 195, 196 area, but we're not there. We're looking up right now. Only if the market did turn back down, close below 204, do we have to talk about those downside targets. Right now, I don't have an upside target, but what I do have is I do have a daily cycle bottom, which should lead prices higher into next week. All right, let's go over to the gold market. And, this is normal stuff. Yesterday, gold spiked up into our 1217 target, pulled back. Today, we're pulling back some more. We're going to test some lower levels. Remember, I said 1170, 1175, maybe it's 1180. In that ballpark are buy zones for gold. So when's it going to get there? I would look for another 2, 3, maybe 4 days of downside in gold. It's not out of the question. But those are buying opportunities because following that, higher prices are coming in gold, just like I believe higher prices are coming in stocks. You're going to see gold challenge 1240, 1270, and then 1300. Those are rough numbers for now. We don't have to worry about them. What we're looking for right now is we're looking for another entry point for the folks that weren't able to get in down here. And so I'm going to be talking each and every day looking for signs that gold is ready to make a secondary bottom. So remember, sometimes we look at how markets move in corrective patterns or acceleration patterns. But in this case, we look for an ABC correction, okay? A, B, C. Now, that's not going to be the whole move, but that's the first move of a larger move. A, B, C. Okay, so right now we're probably in the midst of a B wave. The B wave may come into the 20 period moving average. That's going to slope sideways during this next week. And if we came into that, that'd probably be a good buy zone. It would probably be about 3 or 4 days, 5 days in a row, and then maybe the market would be ready to take off one more time for that C leg, which would go beyond 1217, probably up to the 1240 neighborhood. Let's talk about GDX. I'm glad I remembered. GDX is going to be really in the same camp. It's probably going to be beholden for the most part over the next several days to gold. And we'll have to see how it acts, if it gets pulled down with gold or up with the market, should the market go higher. But I think that anybody who wants to own GDX in here can own or accumulate GDX in here. And all you have to do is you have to say, I'm going to stop out on a daily close. I hate when that stuff pops up. On a daily close below 1729. So you have about $1.50 margin of error on the downside. If you're wrong, close below 1729 and you're wrong, or I'm wrong. But right now, it should hold up pretty good. In fact, if you want to be less risky, if you want to take less risk, you can use 1888. You can use a daily close below 1888, which is the more prudent way to go. You're risking less capital, but you're not giving it as wide of a range of margin, so you could get whipped out of that one before it turns back around. But nevertheless, that's where it is. I think there's higher prices in GDX once gold begins its C leg that we just talked about a minute ago. Okay, so let's go to where would it go? On the upside, we're first going to hit a little bit of resistance at wherever this 50 period moving average is going to be at the time, around 20.5. And ultimately, I think we can get up to 22. And depending on how we get there, we may have further upside targets depending on how gold reacts to the market and how GDX reacts to its own market and gold at the time. So those are the targets I have, insights today. Let's go over to the oil market. Oil had a wild ride, right? So we talked about oil getting up to the underside of this channel. It did that. We talked about it maybe getting into the channel. It would struggle to get into the channel and any higher. It did that. Today it reversed and it came back out of the channel on the downside in a pretty good sell-off, about 5 or 6%. more than that from yesterday's high, but about 5 or 6% today. In fact, well, no, I don't have the updated percentage on my other chart. Anyway, so where we are is, yeah, I think there's lower prices ahead for oil. I think we do move lower into this coming week. And, do I have a downside target? Well, my longer term target is going to be in the mid 30s, but that's not going to happen all at once. And you're going to have rallies in between, and you're probably going to try and get up into this channel, one more time. But I think we're going to have weakness into next week. That's my impression. Just like we have a stock market, daily bottom today. I think we had a similar event yesterday in the crude oil contract. Or market, which was a daily cycle top, so it's the mirror image of the bottom. And if that's the case, then you would expect more downside. And depending on how we got and how much we got downside, maybe later this coming week, towards the end of the week, we may look to see if we're going to see higher prices into the following week. But remember, we're going to have a shortened week this coming week. It's a holiday weekend, and so we're going to have 4 trading days. So we'll see what kind of trades we have on into a long holiday weekend. I don't love to have a lot of exposure going on when that's the case. Let's talk about the bond market real quick. We'll do TLT. Here's the deal. I'm going to take this off pretty soon. We bought it at 124.25, rode it up to here, got stopped out about 130 yesterday, and today we pop back up, and there's probably higher prices ultimately. We could be going A, B, C, just like we talked about in the stock market. In the TLT, A, B, C. That's totally possible. I don't really know. All I know is I was happy with the profit, and what I'm just going to do from here is I'm going to wait for the market to tell me what it's going to do next. So if it runs up, we'll see how it gets there, and if I have a level that would be maybe a shorting territory, or if the market makes a pattern that would be a pattern of weakness or a pattern of strength, we'll take it one way or the other. But right now, I'm not seeing anything worthy of a trade again today. Just got out of it. Don't want to get back in until I see something that says, hey, come get me. I'm here for the profit. So, what I see is upside of probably 135, 136 in the TLT. And if it turns back down again, then, you probably head towards double bottom, maybe 124, 125 area. And if we broke that, we'll discuss that kind of stuff when we get there. But remember, since it's Friday, I'll talk about a little bit longer term picture of the bond market. Remember, this is a longer, let's go even longer. This is a longer term bearish picture in my mind with this reversal bar here. Unless you can totally take it out by the close of March, which is Wednesday, I think, which probably isn't going to happen, meaning take out this red candle here on the upside, which would be a reversal of the reversal. I don't see that happening. So I think that over the course of the next months and years, you're going to work back down. This market is going to work back down to normalize, its behavior from the last 30 years. And I don't think I'm going to get a good picture of the interest rate. Well, maybe I will. Let me see what the monthly looks like. Just give me a second here. No, I wanted a longer term picture. Let's see how far back I can get it. Yeah. So if you look here, this is interest rates. So we're at these all-time lows. Yeah, I know this is the all-time low here, but, all intents and purposes, generationally speaking, we're at an all-time low. Okay. This was an all-time high up here. Well, it wasn't an all-time high, but back in the 90s when we were at 7% on the, this is the 10-year, okay, now we're at less than 2%, all right? Don't you think at some point we're going to normalize? Doesn't everything revert back to a mean of some sort? And if you revert back all the way to the 70s and 80s, the mean could be 10%, 8%, 9%, who knows? Okay, we don't have to worry about that now. All I'm saying is that over the next several years, it's certainly feasible and makes sense to me, common sense to me, that the interest rate market moves higher, reverting back to the longer term mean, which would be this way, Okay? That's just common sense to me. It's not going to go through 0 to negative, right? We know that to be the case. All right, so whether the Fed raises rates this year in June or September or whenever, that's irrelevant. I'm talking about the next several years of development in the interest rate and bond market. All right, I think we're going to leave it there tonight, and hopefully everybody has a great weekend. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.